So if you're running your business now, I think part of what you might be thinking is how am I going to sell this company? And where are we going to go with this, right? And so we're going to bring in Walker from Quiet Light. He's talking about buying a business, buying to grow. But I think on the flip side, Walker, correct me if I'm wrong, we could also think about it as how to structure and sell as well, right?
The private capital markets are all about, how do I buy a business? How do I sell a business? Every time, you build value in your company and go to get that exit, there's always someone on the buying side, right? Yeah. And so what's emerged recently has been a proliferation in acquisition entrepreneurship and individuals actually starting by acquiring an existing company rather than building from scratch. So yeah, we're gonna talk about ways to succeed as a buyer in today's market.
I love it. Awesome. I've got your screen here. I just want to make sure if you're gonna go full screen, I want to make sure it works before I pop out.
Yeah,
we had that issue before.
Yeah, let's do this. If I hit slideshow, I don't think I can see you.
It is full screen and looking good for me, so It should be good. Love it. Awesome. I'm gonna let you take it away.
Thanks, Derek. Really appreciate the intro. Hey guys, my name's Walker Dybel. So if you haven't heard of Quiet Light, we are a online business focused brokerage, right, or M&A firm. And so we help sellers of online businesses exit their companies and have that ultimate payday. 50% of the financial benefit of creating a business or owning a business comes at the exit. And so it's a key place. And we have been brokering these deals for 15 years, longer than anyone else in the space. And frankly, I've been in this market for about 17 years. I've never seen a non-volume based firm. And so that's actually what Quiet Light is. We have no junior employees. Everyone's a successful entrepreneur. And frankly, we turn away about 80% of potential sellers who want to talk to us about selling their business. Not because they're bad, but because, they're not ready, they're not quality, whatever it might be. And so what we provide from the buy side is just a little bit higher quality experience. And so what we're going to talk about today are sort of three things, right? First is going to be why would I buy an existing company and then build from there rather than starting from scratch? Like, why does this make sense, right, as an entrepreneur? Second, we're going to talk about 3 ways to buy your 4-hour work week. And then the third thing is we're going to unpack 7 ways to win as a buyer in today's market, which of course is, especially in the FBA space, more interesting than I think it's ever been. So why buy an existing company? Why would I do this? And the first reason I think is fairly obvious, which is you've got instant revenue, right? So I recently sold a business in the last 4 weeks or so to a first-time buyer, and that buyer closed on his company that morning. And he sent me a text message and said, Walker, I've made $10,000 in the last 4 hours. I haven't even done anything yet, right? So as entrepreneurs, we like to start things from scratch and go out there and, sort of push this boulder uphill. But, when you buy an existing company, it often will have years of revenue, right? So you get to just sort of walk in and purchase this revenue so that you're kind of off the ground on day one, right? Second is you've got instant product market fit, right? The number one reason for failure for startups is exactly this. And so we all know the sort of axiom that, 90% of startups never quite make it, right? I don't know that that's actually true in the e-commerce space right now. I think that it's a lot easier to make it, but 96% of all firms in the United States never exceed $1 million in revenue. So, if you want to, sort of make sure that you get over that kind of hump, then you might want to be, focusing on acquiring a business at that level, right? So the concept here is that you've got instant revenue, you've got instant customers, you've got a proven model that works, okay? And third is that sort of like all of the infrastructure that comes with an existing business is already set up. Let's pretend that you are thinking about starting, an FBA business, right? You're looking at all the data, trying to figure out like, what product should I sell? You're reaching out to China and looking for, where are the suppliers that I can kind of plug into, and you're sort of trying to create this thing from scratch. If you buy an existing company, it's already got the suppliers teed up and in motion. It's got the VAs or the employees needed to succeed. You've already got all the reviews on that product that are going to make it a success or make that launch a success. And then, of course, you've got the existing customers or even subscribers. So all of these things come together to provide a fully operational business with history behind it and momentum in front of it, right? Next is, look, just coming at this as a business decision, right? It's got positive returns to the point that there's no other asset class out there, period, that gets the same returns as buying a privately held company, okay? You've got existing profits on day one, current cash flow on day one, right? If you're buying a business that is unprofitable, that's your fault. You shouldn't do that. You're buying it because of the cash flow, right? So you've got immediate cash flow coming in. That cash flow can pay you. That cash flow you can reinvest into new product launches. That cash flow comes in and also pays down the debt, right? So the next point here is they're financeable. Due to recent trends in SBA loans, you can actually go out and kind of borrow up to 90% of the transactional value of these businesses. And with that, the cash flow that comes in builds up your equity. So you're effectively moving real estate economics really into entrepreneurship that allows you to capture that ROI from a small down payment and the equity build up to the full valuation. And third is really the growth opportunity. So, let's use that real estate analogy, right? So I'm going to buy a building and, I'm going to kind of hope that over the next, 20 years, it's going to sort of, appreciate 2 to 3% in value each one of those years. In a business, there's no ceiling in terms of like what's going to dictate how fast you can grow that business, right? So let's just say that you buy a company that's doing $1 million in revenue. You take the existing cash flow and launch new products. You effectively double the size of the business over a 24-month period. Okay, and so you've got this growth opportunity in the business that you're buying. It's financeable, so you get the equity build up, and you've got that instant cash flow coming in to sort of pay for all of these things, including you and your time from day one. This model is so proven that like the largest finance industry is based on it, right? And it's called private equity. So I'm not making this up, right? It's just one of these things that like it's always sort of existed in sort of its institutional form, and like Wall Street and going out and hostile takeovers of publicly traded companies, all these kinds of things. But the truth is that we all know that private equity is one of the financial backbones of the world, right? This is the model they use, right? And so I'm discussing it today in just a smaller form, whether that be you want to buy a company at 250,000, $1 million, 2 million, 5 million, whatever. Add zeros until the numbers are interesting to you. When you look at who's buying online businesses, right? I mean, historically, it's sort of looked pretty similar to this. This chart is sort of directionally accurate, right? So this sort of like, let's say 250,000 to, a couple of million is sort of like individuals, right? Like often first time, acquisition entrepreneurs or those that are growing through acquisition. Last year at eCommerce Day, I did a whole talk on growing through acquisition, the economics, the sort of evolution and why it's such an effective growth strategy. So I'm sure that video is somewhere in the archives, and I'm sure you can find it. Please watch it if you're interested. But then you've got these private portfolios. So there's a lot of online entrepreneurs that are like, hey, I'm going to buy whatever a dozen or 2 dozen different websites or different FBA businesses and sort of roll them up because they maintain all of the same core competencies, right? And then you sort of move into these micro funds and syndicates, and ultimately you're getting into the private equity, which is this institutional capital that ultimately they're looking ideally for between 2 and 3 million in earnings before they really kind of start come in and really start playing in that space. Of course, as of recently, especially and specifically around fulfilled by Amazon businesses, all of this has been a little thrown off balance. And the reason why is the aggregators have moved in. And aggregators are essentially private equity firms that have come in, and the numbers keep changing. As of last week, they've raised $6 billion across 60 different firms, and they're coming in and trying to buy FBA businesses that are doing largely $1 million in revenue and up. Okay, and so they're dropping down for private equity, which is sort of disrupting acquisition entrepreneurs and how they actually buy. let me back up for a minute and just tell you who I am. Like, how do I know all this stuff, right? The big takeaway of this slide is simply that I've been in every seat, right? I've started multiple companies from scratch. I acquired about $16.5 million in revenue across 7 different companies over a 10-year time period. And I'm talking 100% buyouts of these companies, okay? Largely with debt, right? Then I enjoyed 2.5 exits. So I've been in the sell seat. I say half an exit because I did have a tech startup, a SaaS company where it failed, but we were sort of able to finagle sort of 10 cents on the dollar for the code base. So not the highlight of me being a seller, but you know, I've enjoyed a few exits, a couple of 7-figure exits. I've got an MBA where I now am actually an adjunct professor at the Olin School of Business, where I teach entrepreneurship through acquisition, or how to buy companies. Okay. I was licensed by the Securities and Exchange Commission. I've got all the sort of private capital market certifications, and I've been, you know, featured as thought leader of the year and published in a lot of different publications. I wrote about my journey of acquisition entrepreneurship and buying all of these companies in probably what is the best-selling book of acquisition entrepreneurship or buying companies out there. It was featured by Forbes as one of the top 7 books all entrepreneurs must read. And is used by multiple universities as a textbook. Okay, so it's just a little about me, and the concept here is I've been in all 3 seats. I practice what I preach, and I own multiple companies right now, and even have a startup on the side. Some businesses you need to start, others make a lot of sense to buy. Okay, let's talk about 3 ways to buy your 4-hour work week right now. Okay, number 1. Don't focus where you can't win, all right? We touched on the aggregators, okay? FBA has this institutional capital just pouring in, all right? And what that means, team, is that you've got, you know, we've got this valuation expansion happening on fulfilled by Amazon businesses that we've never seen before, okay? It's never valuations have never been this high. That doesn't mean that you can't win. You know, paying a higher dollar amount than you could a year ago for a business. It still has a margin of safety. They're not insane, okay? But the biggest thing that aggregators really bring is that they have the cash and they close, right? As of the end of 2020, we at QuietLight basically ran some math and predicted that we actually were involved in about 70% of all transactions to aggregators to date, and that was like the last week of 2020. That's changed quickly. You know, going from a dozen or 2 aggregators to about 24 aggregators, or sorry, to 60 aggregators, just in 6 months. You know, the investors of the aggregators are insisting and dictating that the aggregators go directly to sellers and try to get them to sell directly. And you know, why would they do that? Obviously, because they get better deals. I will say that individual buyers in 2019, in 2020, and still in 2021, individual buyers tend to make better offers than aggregators. Keep that in mind. The thing that makes them different is that they have all the money and they close, right? So if an aggregator comes to QuietLight, they know that we're actually a repeat customer of theirs. They want to show us that they close. So just to give you an example, you know, Amazon, you know, let's just say like even last year, if you talked to me as a buyer and said, hey, I'm thinking about buying an FBA business, what do you think? I would say, great. It's a great platform for e-commerce. What I want you to understand, though, is that Amazon can be a single point of failure, right? There's 0 channel diversification on Amazon. And, you know, I was a reseller on Amazon. So I think I was the first sort of profile of person to realize that they're not nice all the time, right? And more recently, you know, sort of the content sites are, you know, they got all their fees cut, right? And so the third-party resellers still seem to be in a great place with Amazon. But the thing is, you know, they really have all the control. And so how is that going to play out in the long term, right? And you still, you know, you don't own the customer. You don't even know who your customer is, right? So there's some downsides to FBA businesses that need to be considered if you're actually going to be acquiring. And if you do go in this space, my recommendation would be to look at businesses that are sub $1 million in revenue. So if you can find sort of a nice $500,000 to $1 million revenue business that's on Amazon, you're going to be able to edge out the vast majority of the institutional buyers that are coming in and sort of willing to pay, whatever, at least signal that they're willing to pay whatever. Number two, embrace this channel diversification. Okay, like don't just think because the aggregators are really loud that they're sort of telling you the right place to be. Okay, it's a business model that they're going after. They've got a lot of portfolio theory at play. And so the thing is this was true last year. This is true now. This was true 5 years ago. Omnichannel, Google-based. Okay, they've got less risk and more stability for someone like you. I've got an e-commerce company, 3 actually, all Google-based. I know my customers. I interact with them. I've got an email list. It's fabulous, right? And so look for these types of businesses because they're being completely ignored by the institutional capital that's out there buying up in this space. Yes, and you've got less buyer competition. So far, there's zero aggregators or institutional capital moving into off fulfilled by Amazon businesses. There's a couple making noise and starting to kind of drift that way, but I'm not seeing any momentum yet. So it's a good place to go to sort of dodge that buyer competition, right? Third, look for non-e-commerce online businesses, content, SaaS, info products. Let's talk about content for a second. Let's just say that you're interested. You're here at e-commerce day because you're like, I want to start an FBA business. Like, I know this is a great way to launch a brand. It is. The thing is you do have to start from scratch. You've got to do the successful launch. You have to find the product market fit, all of the other things. So, if you wanted to buy a company, okay, you might look at a content site and say, okay, I've sold content sites in, I don't know, fishing, in coffee, in food, in probably anything you can think of. The point is that like, music, computer science, whatever. The point is like, let's just say you want to start a company in, deodorant, and you want to launch deodorant on Amazon. Okay. Maybe you want a content site that talks to those readers, right? That says, hey, I'm generating $1 million in revenue with this content site over here. And it's something that as I launch my FBA business, I can also create content around, the best deodorants to use, and like, basically run them over to my FBA business over here. Why wouldn't you do that, right? Why wouldn't you do that? So it's just an idea to help you think about where you can go to kind of win, right? Let's see. Now we move on to 7 best practices to win as a buyer in today's market. Okay. Number 1, get your financing in order. Okay. There's nothing worse than being, a broker or with a seller that like just, they don't know what they can afford. They sort of don't know what they're looking for. You can get pre-qualified with an SBA loan today, through e-commerce lending or any number of other lenders out there that have started doing this, that will talk to you and review your financials and tell you how much your sort of budget is in terms of what you can afford. Okay. If you get your financing in order, then you're sort of coming to the table prepared. And a lot of times, a lot of these companies, they'll go under contract, definitely in a couple of weeks, right? I mean, and often faster. So it's one of these things where you need to sort of get ready before you start showing up at the table as a shopper, right? Or as a real buyer. Number 2, do what you say you're going to do. And I mean, this is true in all aspects of life, right? And I think we all know that. But the thing is like, the seller has a lot engaged with their buyer. And what you need to know from the buy side is that, when you offer a letter of intent, okay, to a seller, what you need to understand is this is a really emotional thing for them. Like, they're like, all right, I'm like, there's a lot at stake here. We're going with Jimmy. I really hope he closes, right? And so the thing is like everyone's always looking, you as the buyer looking for, okay, we're going to run them through diligence. We got to do financial and legal and operational and figure out how the sausage is made. That's all great. You should do that. Figure it out, please. But the point is that like the seller is really like watching you to say like, okay, is this person, doing what they're saying they're going to do? Are they over communicating? Are they being a good partner in this transaction? Okay. If you come into this thinking that you're going to blow smoke and, be dodgy, it's probably not going to work out. And so, just be a good buyer, right? Confidence and speed to closing is the number one thing that sellers will decide who to go with. And I am serious. In other words, we all like to think that it's sort of like, oh, whoever has the highest bid is the one that's going to come out ahead, right? The person that's going to win the deal. That is true very often, but not all the time. And so really, after we get a few offers in, say, I'll sit down with the seller and sort of say like, okay, look, we've got some offers. Let's just start here. Who did you like the best? Who's the best fit for your company, right? And we'll start to think about who's a good fit, and we'll start to say to ourselves, okay, who has the most confidence and speed to closing, okay? And so these are the things that you have as a buyer in order to win that deal, okay? And the more you cast this aura around you, that you are confident in what you're doing, that you are going to move fast, that you are going to be on it and you want to close, those are the sort of intangibles that will win you the deal, okay? 4, don't overestimate the cash buyer. Okay, look, we all fear like, oh, like I'm using debt and some cash buyer is going to come in and just sweep it out, okay? Valid concern, okay? But what I want to say is number one, cash buyers, there's 2 things about them. Number one, if I'm taking, $1 million out of my bank account, you better believe that my spouse is wondering what the hell I'm doing with all that money, okay? And I don't care if I have, 100 million or just $1 million. My wife wants to know, where's that $1 million going, right? So very often, even people that are cash buyers want the ROI that comes with the equity buildup. So they'll take actually a loan on their assets and buy with that. So guess what I just said? They're taking a loan, okay? Are they more financeable than you? I don't know. Are your finances in order? You following me? So it's one of these things where they're getting a loan almost all of the time. And the thing is that cash buyers, people that make offers in cash with no financing contingency, trust me when I say it's not free, okay? Diligence is harder, okay? They more often renegotiate, okay? Because this is like their money, that they're sort of pulling out of their account or whatever, and they're not taking as much debt usually. So the thing is that don't fear them. They've got their place. Of course, all sellers like them. You'll like them too when you're selling. But there's a lot that goes into it, and often someone that's getting, say, 90% of the purchase price in cash from the bank, they're a little easier around the edges to work with, right? Because it's like, I can't believe that I'm getting all this money. It's just falling out of the sky so I can buy this company, build up the equity, pay myself, launch new products. It's actually a really great business model. And so it gets all of us excited, me as well. Number 5, look, genuine gratitude and personal connection. I'll tell a really quick story here. I bought a company with Quiet Light, right, as a buyer for a little over 10 years. And when I did, what happened was I was trying to buy a different company and I lost out, okay? And what happened was I was on the phone. Joe Valley was actually the broker. And, I started the call with, the broker was like, look, we're here to answer questions. What do you got? Let's go. And I said, look, everyone put their guns down. I just want to say that, I'm interested in this business because I can tell that you have worked hard to build this, and I'm interested to buy this because this is an exceptional company. I mean, look at what you've done here, right? I didn't know this at the time, but you could almost say like 96% of all companies in the United States never exceed $1 million in revenue. And so what you have built is exceptional, okay, by all measures, right? And just doing that kind of intro and showing that you appreciate what they've spent years of their life on can be enough, to win you a deal. Anyway, I lost that deal, but the point is Joe was so impressed with my intro that a private listing came out a month later from a different broker, and Joe said, call Walker. He's a great buyer. He's teed up. He's ready to go, whatever. And the point is that private listing, of course, had less buyers, came right to me. I knew what I wanted. I bought maybe 4 or 5 companies at that time, and I was able to review it, evaluate it, and put an LOI in the next 24 hours, I think. But showing gratitude to that seller, and just sort of cultivating a personal connection, because you're going to need that person after exit as well. We're in a deal right now with a private equity firm, and they're slow to respond on everything. the personal communication is kind of lacking, and they're using their sort of let's go on to number 6. Look at what the aggregators are advertising to the sellers, and look at what they're telling their investors they're paying, and look right there, and you'll see a gap. Okay, and there's a lot of hype around what the valuations that these people are that these companies are paying. And what I want to tell you is there is a gap between what people's expectations are and what they're being told and what's actually happening kind of behind the curtain. Okay. In other words, there's a lot of middle market structures that you can use to make things look like they're being sold at a high valuation, but sort of like the cash at closing is much lower than what's being advertised. And then there's all of these other things. Let me just throw out one example. Okay. If someone says to you, hey, we want to buy your company, and like we have this great profit sharing plan where you get to make money off of the company for the next couple of years. That sounds awesome, doesn't it? That sounds awesome. I would want that, right? The problem is let me say the same thing slightly differently. Hey, I'm going to give you a little money today, but don't worry, I'm going to give you more money later to make up for it. And what we're going to do is peg it on an earnout so that after I take control of the business, if I perform, then you'll make more money based on the future earnout potential of this business. Earnouts are like the least favorite deal structure of any seller. Profit sharing and earnout is exactly the same thing. Okay, and so whatever that sort of future projection is can be sort of construed to come up with the total enterprise value of the company, but none of that money, maybe it gets paid out, maybe it doesn't. We'll see. All these companies happen to be brand new. Okay, most of them anyway. And there's good people out there. Don't take what I'm saying as these are all bad people. They're not. There's just a lot of people moving in all at once, so the range is pretty big. Don't fight over months. Okay, and here's what I'm saying. Sometimes a buyer will come to me and say, Walker, I love this business. What do you think I should pay for it? And I'll say, well, what's the asking price? And they'll say, well, it's, $2 million. And I'll say, okay, well, how about $2 million? What's the multiple of earnings on this? Well, it's a 3.4. Okay, so about 3.4 years worth of earnings that you're paying. What do you think about that? And they'll say, well, there's some things about it, that I think maybe I should, talk them down to sort of like a 3.1 or 3.2. And I'm like, okay, keep in mind, going from a 3.4 multiple to a 3.2 multiple, you're really fighting over 2 months, a 0.2 of a year. I can't even do that math in my head. It's not even 2 months of earnings. Okay. Is it worth it to you to lose that deal if we know they're going to take $2 million? Okay. And so a lot of times buyers will come in and be like, well, I don't want to pay a 3.4. I want to pay a 3.0. Fine. You need to do what's right for you. But you also need to understand that if the asking price is a 3.4, that seller is mentally prepared for a 3.4. If it's coming through Quiet Light, there's I think it's 41, almost 65% chance that it's going to sell for that anyway. We're really good at figuring out what the market is actually going to pay for a business right now. And so and by the way, the other percent is above or slightly below. So the point is the asking price will often get the deal, and you need to kind of ask yourself, do I want this, or is it really important to me that I sort of buy it right? And a lot of times, fighting over fractions of a multiple are really just looking at months of earnings and not even necessarily worth your time. Okay. In terms of things to do, if you're a buyer interested in buying, please go sign up for new listings on the Quiet Light site. Here's why. I bought for over 10 years. All right. And the thing is that I was licensed, I was a broker for publicly traded companies. Okay. Middle market companies, lower middle market companies. I bought Main Street, I bought online, I bought offline, I bought all of these things. I knew all of the brokers, all the M&A advisors. I had a lot of exposure for a decade. Okay. At the end of the day, I got kind of recruited. I bought a business, and the broker said to me, hey, I actually want to sell you my whole brokerage firm. Like, you should be the successor of my firm. I was honored, but I always knew that if I was going to do this, I would only work at Quiet Light. And so I had a couple of firms, even 2 firms, flew out from the coast, take me out to a steak lunch. They wanted me to sell these $50 to $100 million deals. Again, honored, felt too corporate for me. I'm an entrepreneur. I called Mark Dallas at Quiet Light. I said, listen, I'm being recruited. I've been doing this for a long time. I love doing deals, almost more than I like operating companies at this point. If I were to do this, I would only do it with Quiet Light, okay? And the reason why is because from the buyer side, I get so much good information that I can make a quick decision, okay? And they're always drafted, the business summaries are created by people who have operated businesses, okay? And as a result, there's no junior employees at Quiet Light. So as a result, the information is so much better and so much more insightful than any other firm I've seen in any of these market segments, okay? That was the little thing that made the big difference. And so even when I work with buyers that are looking offline, I tell them sign up to receive new business listings from Quiet Light Brokerage, because when you compare them to any other firm out there, you'll start to see the gaps of information that other sellers or other brokerages aren't sharing with you that you need to be asking. So it's a great place to get educated and to sort of find out what type of business that you might want to buy and the types of things that make you comfortable or sort of more risk averse. Okay. Lastly, I sort of have 3 calls to action here, right? Which you're never supposed to do. So look, buy then. If you're interested in this, buy then build. I think the ebook is whatever, $6 or something. If you go to buythenbuild.com, you can sign up for a free 3-day video series to learn about buying companies and why it makes sense. If you're really into this and you want a world-class instruction as well as a do-it-with-you buy-side advisory, I've started the Acquisition Lab in order to help vetted cohorts of buyers find and acquire their business. And lastly, if you're a seller, if you're an existing e-commerce business, okay, call us at Quiet Light or sign up on the website. You get a free valuation. This is important whether you want to sell or not, okay? Talk to me. There's 14 of us. It doesn't matter. If you want to figure out, when am I going to exit? What are the things that are going to drive the value of my company? When is the right time to sell? What is the market doing? What are the different aspects of my company? And will allow you to get your footing in regards to, what are the levers that you can move to make sure that you're prepared on the day that you want to exit your business. And again, sort of harp that 50% of all financial benefit that's out there. And a secret 4th call to action. Joe Valley wrote a brand new book called The Exitpreneurs Playbook, which is wonderful for sellers, but also buyers, because it teaches you about how companies are valued and the different levers. So, Derek, thank you so much for having me here today. Sorry to have my 6 calls to action.
I love it. I'm grabbing the link to this book on Amazon so that, I got it right here. Should be able to share it with everybody here in chat. I've got my copy of Buy Then Build as well. I read the whole thing. I really, really love it. I am missing a signature. So we're going to have to figure that part out later.
Put your address here in the chat.
Yeah. For sure. So you talked about that multiple difference between 3.4, 3.1. I'm just really curious, and all the things that we might need to do before we exit to pump up our valuation. I'm imagining a lot of valuation is centered around retention. But walk me through what are a couple of pillars of how we bump that valuation up from as low. I'm sure you've seen low multiples like in the 1 to 2 year multiples, and how do I get up to a 5 or 10x multiple if that's ever even happened in e-commerce? I don't know.
Yep. So what I would say is Quiet Light has the sort of 4 pillars of value that we sort of always preach. At the Acquisition Lab, I came up with what I call the 7 elements, right? So it's sort of which one do we want to go through? What I would tell you is that look, the fundamental drivers of value are going to be growth and earnings, right? So let me just talk about the things that are going to make the biggest difference in your business are financial and 100% financial. Okay. In other words, if I've got a business that's doing $500,000 in revenue versus one that's doing $1 million in revenue versus 10 million versus 25 versus 50, all of those are different ballparks altogether. Okay. Yeah. And so it's and then growth in terms of if I tell you I made $1 million this year, you're gonna go, Walker, that's incredible. How much did you make last year? And I say 2 million. You're gonna go, horrible, right? So you really want to be going in the right direction in order to maximize where you are, in the ballpark, right? Now, of course, valuation is. I'm looking at the clock, knowing we've got 5 minutes, and I could talk for 8 hours. What I would say is there's also there's 3 things that any seller should really think about. Okay, the first is, what are you gonna do after you sell? Do you really want to sell your business, right? That's like number 1. What are you gonna do, right? And number 2 is, what is the sort of your internal financial goal? Like, don't worry about anyone else. Think about, what is your goal around your asset? So is this something that, I built an FBA business and I'm ready to sell it in 24 months? My bar is going to be a lot lower than if I start a company and I've been running it for 30 years and I'm going to get 1 exit, right? It's a different mentality. And then the third thing is, what's the market doing? Because the M&A market always moves like a sine wave, right? And it's one of these where, even in 2018, I was talking about how this is the first M&A market upswing that online businesses have been able to participate in, okay? And so now we're starting to see, this institutional capital come in as well. And it's kind of elevating it to new heights.
Does that mean now's a good time to sell?
So again, there's 3 things in terms of the external sine wave. Yeah, now's a good time to sell.
Okay, yeah,
good time to sell. Mm-hmm.
Awesome, amazing stuff. I absolutely love it. Thank you so much for joining us. And I linked the other talk on acquisition of companies through growth. I really, maybe next time we talk, I want to get into that a little bit more, because I think there's always something to be said for just acquiring your competitors. I'm looking at this as well myself. I acquired eCommerce Day last month, so here I am.
Your case study. Why am I talking? I should have been interviewing you.
Yeah, it's different for every business, but I think it's either about complementary or competitive products, and building out that vision of taking on a market and carving out a serious share of it. And I think that a lot of people maybe think so much about acquisition, retaining their own customers and things like that. They forget, like, oh, my competitor's doing a sale. They go, well, we have to do a sale. Well, what if we just acquired the competitor and then we do less sales? We'd actually have higher profit margins. So we should figure out how to do that.
That's what Rockefeller did.
Yeah, exactly. Yeah, and do it until it becomes a monopoly. And in most spaces, you actually can monopolize without getting in too much trouble, till you probably go a little high up in the ecosystem.
Yeah.
But
Derek, Godspeed. Thanks for having me here today.
Absolutely. See you later, Walker.